In this week's update, signs of a major bottom intensify. But is this just a dead cat bounce or is it something else? What does confirmation look like and what are the risks? My name's Garry Davis. As always, this is general advice and please remember to like and subscribe to the video. Let's do a quick status update. Over the last 3 weeks, I've been indicating all the signs that would seem to point to an end to the bear market. It's not been guaranteed. All the boxes hadn't been ticked, but progressively over the last 3 weeks, there certainly have been more and more. And none of the boxes that were ticked over the last few weeks have gone the other way. So we're pretty close to the confirmation of a major low. We're almost there. So what I want to do today is just look at what would do it, what would be the final few boxes to be ticked that would indicate a major low. But let me make the point that even if this is confirmed as a major low on a multi-month basis, this is still an environment where something can change that could trigger another slide in the market. So by no means does this mean that the worst for the stock market is necessarily over. So from here, it's just so important about risk management. So what could go wrong? Well, I think the thing that we need to see, and it starts next week, is earnings in the US. And if earnings were to disappoint, then that could trigger a further multiple contraction. Now, we've already had a pretty significant multiple contraction already in the States from a market that was for many years was too expensive relative to the growth in earnings, and that was all about the ultra low interest rates. This earnings season, only a third of S&P 500 stocks are providing a positive earnings per share guidance update. That's good news and bad news. It's bad news on the surface because that's a fairly low number, but it could be good news because if the market has already priced in that much or something worse, and stocks actually outperform expectations, even though earnings, may not advance, it all depends on what the market is pricing in. That's the key. The second thing that could go wrong is that peak inflation expectations are wrong. So the bond market has been saying, and increasingly more economists are saying, that we may have seen the peak in inflation. That's all based on assumptions about the future. If inflation hasn't peaked and we get a continual surge, then that obviously changes the equation as well. So the task then, given these uncertainties, is to identify stocks that are going to be resilient to margin being squeezed. And by margins being squeezed means that costs are going up, prices can't be passed on to the consumer, and the company's profit margin gets squeezed or gets obliterated altogether. So this is an environment that is still quite unpredictable, but that doesn't mean that we can't or shouldn't participate. It very much gets down to how to participate. What are the kind of stocks that are that are going to sail through this period relatively unscathed anyway, and with such a significant amount having come out of some really, really good stocks, then this could be a lot more upside than downside. So let's just look at things realistically, step back and look at what might happen. So central banks are now very focused on trying to kill off inflation, or at least that's their rhetoric. Now, we don't know how much of that is just rhetoric, that they really don't have the intentions of taking interest rates up to the sort of levels that some members of the RBA, some members of the Fed are talking about. They're just trying to, scare the market into cooling the economy. But the risk is that, central banks could get engrossed in this process and could overreact to the need or the perceived need to kill off inflation. And I think there's a pretty good chance that they will back off. If they do that, I think they'll back off as soon as the inflation data shows any indication of cooling off, and there's a couple of reasons for that. It's hard to see, if we do get a contraction in earnings, that we're going to continue to get a surge in inflation. Those two things normally aren't linked. So it's likely that if we're going to get an earnings contraction, then we're also going to be seeing a retraction in inflation. Again, that's not guaranteed, but it's certainly the likely outcome. The other aspect for central banks is that with so much debt in the world, long-term rates just can't get pushed up too high. And the peak in interest rates is probably a lot less than is currently being priced in. Now, central banks aren't stupid, and they're not going to drive economies into a disastrous recession just because of the ideology of controlling inflation. Not once they start to see the impact on debt repayment. So I think that is something that will be a ceiling, if you like, on what the central banks are doing. So stocks that have got sustainable earnings growth, truly sustainable earnings growth, even in the face of rising costs and perhaps less consumer demand, they're able to pass those rising costs on. Their business is still very resilient. They should get a kick higher as the market starts to understand that perhaps rate expectations have just gone too high. And if we look at Australia, the futures market, the bond futures market in Australia is pricing in a cash rate of 3.5% in the first half of next year. That's what the market is saying. But there are increasing indications that a peak around 2.5% is more likely. It's well short of where the futures market is currently pricing. And we've seen fixed mortgage rates on the rise from last year. So that ultimately has to flow through and have some sort of dampening effect. We're certainly seeing consumer confidence has fallen quite a bit, and we're now seeing falling house prices as well, which has a wealth or a negative wealth effect. So all those things indicate that the economy is cooling. So it's pretty hard to see the Australian interest rates getting to a cash rate of 3.5, and yet that's what the market's priced in. So, we'll just have to see how that one plays out. So I think there's a very good chance that the RBA won't need to go so high, the Fed won't need to go so high, and once markets get some confirmation of that, and let's face it, over the last 3 weeks in the US, the rotation back to growth and aggressive sectors, and it's even happened a bit to a degree in Australia as well. We've seen some tech stocks that were formerly on high multiples that have been absolutely murdered down and now starting to turn around and rebound, and we've seen some quite nice rebounds in the last week. So I think once the market gets a sense about that, we could see this rotation continue. Now, all we have is what we can control. And despite what many people might think, we can control most things in the market. We obviously can't control what the market pricing does on a day-to-day basis, but we can certainly control many, many things in how we actually function in the market and the sort of stocks that we buy, the way that we buy them, the level of exposure that we have. Most things we can control. So just do that. And, don't wring your hands about what the market is doing. Just focus on what we can control and be clear about what we're trying to do. All right, let's take a look at some key charts now. So we'll start, first of all, with the S&P. All right, so there's the S&P. We had a nice bounce last week, as you can see. We've now got a higher, or potentially a higher low. We don't quite have a higher high yet, but look, at the index level, I'm not terribly concerned about the pattern around the index. Far more important is the ratios that show the market rotation, because the bear market will be over when we've got absolute confirmation that money is flowing consistently back into the more aggressive sectors of the market. Before I go to those spread charts though, let's just look at the NASDAQ. So the NASDAQ looking fairly similar, almost back to the 50-day moving average on the index. Again, probable higher low. We just need a little breakout here to get a higher high. But the important ones are the spread charts. So we'll start with probably the most important one. This is the NASDAQ versus the S&P, and you can see now that we are clearly, and we had a good week last week, we're now clearly in an upward sloping channel. We're getting higher highs and higher lows. It's not as robust as we've seen in some other turns from a bear market to a bull market. And that's understandable given the current disruptions and the fact that we're at the start of a 40-year reversal in interest rates. It's not surprising that this rebound could be more tepid than what we've become accustomed to. But there's no question we're now in an uptrending channel. So that's pretty positive. If we look at consumer discretionary versus consumer staples, again, pretty good week. This one's not as definitive as I would like. I would like to see a close above this 2.1 level here on the ratio. But it's understandable because the American consumer is getting just as squeezed as the Australian consumer is. So it's going to be difficult to see consumer discretionary spending doing a whole lot, but nevertheless, it's at least holding its own. This is the Russell 1000 growth versus 1000 value, and indisputably a really strong uptrend. Robustly higher lows and higher highs. So that one is looking particularly good. The small caps, Russell small cap growth versus small cap value stocks. Again, this one has been looking increasingly promising since the 27th of May. So that's another box that it's been ticked for a couple of weeks, but it's just another strong week. You can see two of the last 3 weeks have been quite strong. Is a promising point. And finally, this is US large caps versus large cap growth versus large cap value. And again, higher highs, higher lows. So plenty of good things are happening on that front. Now, the other chart that I want to look at is the 10-year Treasury yield. Let's look at it over the last 3 months. So we've got a series of lower highs, lower lows. So ideally, if the 10-year yield continues to contract, then that's a pretty good sign that at least the bond market is saying that that inflation is not a problem. And in a falling yield environment, that's going to be good for aggressive stocks. Now, we came down below this previous peak last week, I think it was. So several boxes have been ticked. One thing I want to see here and one thing I don't want to see. I don't want to see this going back above 3.5. So as long as it can hold below that level, then I'm comfortable. Ideally, I'd like to see it form another lower low, which would be below 2.8. So by this time next week, if we're back down by below 2.8%, or maybe in a couple of weeks' time, then I think that would sort of be the final confirmation that I'm looking for, that this rotation back into aggressive growth stocks is the real deal. Okay. So just to finalise on this slide, on just focusing on what it is that we can control, and stop stressing about what the market is doing on a day-to-day basis, because we can't control that. Just do the things that are consistent with your trading plan. Be clear about what that plan is, and just clear the media confusion and the other voices in your head, and just focus on the important things. American stocks, S&P, the scoreboard says it was up 2% for the week. It is normal for the US market to have a run up into earnings season. So this could just be the seasonality, the strength that we saw last week. Running up, the market has priced in too much negative, has a bit of a run up leading into earnings season. So we won't really know about that for a few more weeks until we see the nature of the earnings season results. But on Friday night, the jobs number came in above expectations. That caused yields to rise back up again. But very surprisingly, the rotation into growth stocks continued. So it's only one data point. It's only really a few hours. The bond market yields went up before the market closed. But it didn't seem to stop the rotation into growth stocks, which is unusual to say the least. So very keen to see what that 10-year yield does next week. But there's no question at this stage the data is still saying, the data via the jobs numbers is that inflation is still an issue. However, as we know, markets look forward. They don't look at today's data. They're looking 6 to 12 months ahead. And the bond market is generally a lot smarter than the equities market. So I'm taking more cues from that area. The US dollar index was up again, actually got up above 107. So the US dollar remains in a very strong uptrend, and that's not helping for commodities. Finished just a tick under 107. The yield we saw, the VIX continued to drop. So again, we've got a situation where you wind back to earlier in this year, whenever the bond rate went up, or the yield went up, the VIX went up as well, because money was rotating out of growth stocks. Despite the yield rising, growth stocks got more traction than otherwise, and the VIX fell down to 24.5. Still high, but at least it's heading in a downward direction. The 2-year, 10-year spread has now rolled over. It's only just negative, but it is negative. So the chances of recession, the market is now saying, not what some commentator thinks, the market is saying in the bond market that a recession is a possibility. And I'm sure that won't be lost on the Fed either. Aussie stocks, our dollar got down to the low 67s, finished at 67.84. Our market rose 2.1% across the week. The main driver of that was healthcare. Materials got hit pretty hard for obvious reasons, with the currency impact, with the iron ore price coming off, and also the oil price coming off. The current market dynamics with around all commodities, copper's come off a long way, other base metals have come off a long way. Plus, small caps are being shunned in Australia just on liquidity reasons. So the market dynamics are really difficult for battery materials stocks at the moment, but the long-term outlook remains really robust. If you're a short-term trader, then it's difficult going, because we're getting a lot of very illogical fluctuations in small-cap battery materials stocks. But if you've got a view of where these stocks are going to be in 1 or 2 years' time, the outlook still remains incredibly robust. So to me, it's still a very exciting long-term story. It's just we're going through a difficult patch with the way the market is, I think, very unfairly treating a lot of these companies. Some of the small cap miners in Australia that have got world-class resources are trading on market caps that are just way too low for the resource that they've got. And I'm sure in time the market will reverse that. Okay, so let's just look at a couple of other charts. So we'll have a quick look at the US dollar. So you can see we actually peaked out at, got close to 108 at one stage. So very strong rise on the US dollar. Our dollar going the other way, but we did have a little bit of a bounce towards the end of the week. ASX 200. You can see we may be carving out a bit of a bottom, or this could just be a pause before another leg down. there's nothing really that definitive at the index level in Australia. But that index in Australia I don't think tells us a great deal, because it's just so dominated by a handful of stocks that I don't think it's useful indicators. I'd much rather be looking at the sector level and the individual stock level. There's materials. They were doing absolutely wonderfully well until April, about mid-April, and then it all fell apart from there. They've been holding up extremely well. Healthcare probably did the best last week. You can see quite a strong rise. CSL contributed to that to a fair degree. Banks looking pretty similar to the index, so a bit indeterminate, and I think it's going to be a tough environment for banks. Lending volumes are almost certainly going to be down. The provision for bad debt, whether they actually see an increase in bad debt or not, is not the point. The provision for bad debt surely has to be ratcheted up, and that's going to impact on their earnings and on their ability to pay dividends. And energy has certainly come off a bit, but stabilised to a degree last week, I guess helped a bit by the falling Australian dollar. Sorry. Okay. Turning now to precious metals, gold was down by a very large $68 to $17.44. I just have no explanation for what gold is doing, so I won't even try. There's just no logic. In this environment, gold should be doing better than it is, a lot better than it is. So I'll just pass on that. Precious metal stocks. Over recent weeks, precious metal stocks led the way down, which is normal. At this stage, we've not seen a turn up in precious metal stocks. So if we look at those charts, so that's the daily chart for precious metals. You can see it got hit very hard on Tuesday and Wednesday. Stabilised into the end of the week, but if we look at it on a weekly, it's quite a sharp move, and we're getting back down towards the lows that we saw in August of last year, and then also in the COVID crash in 2020. If we go to GDXJ, certainly led the gold price down, which is what you normally tend to see, but no sign of this turning up yet. So I don't see anything positive on the gold front. Other commodities, copper was lower again. So copper is certainly saying that a recession is coming. Nickel was also down. Remember, wasn't that long ago that nickel was trading at $25, $30 a pound. It's only at a fraction now of what it was during that spike that we got earlier in the year. And as I said last week, the supply and demand reality is still really strong for copper, nickel, lithium in particular, graphite, cobalt. So long term, those market dynamics still look really, really positive. But at the moment, it's just the fears about a global recession is what's impacting on those prices. Crude oil dipped under 100, but finished back at almost 105. But it was a bigger range this week. The last couple of weeks, that range from peak to trough has been about $10, got up to $15 this week. So crude oil also showing a lot of volatility. Spot copper. You can see the slide has been quite dramatic just since really the start of June. So it's only really been 4 or 5 weeks. And we've come off from around $4.40 down to under $3.50. So that's been quite a dramatic fall. And that certainly hasn't been helping the local mining stocks either. Nickel is holding up better than copper, but it's still been in decline over the last 4 weeks. So wrapping things up, there are a lot of uncertainties out there, and I suspect that those uncertainties will remain for some time. So therefore, it's best just to tread a conservative line. I think the worst thing you could try and do at the moment is to try and quickly recover your position by taking adverse risk, because you might just make things worse. So I think it's better to tread a conservative line, be alert to the stocks that are going to lead. I've certainly got some strong ideas about what should lead, but at the end of the day, I'm always led by what the market is actually doing and where the big money is flowing. So we'll just have to wait and see, but be open-minded and alert to the stocks that are leading. And don't wait for the guy to ring the bell that we've had the end to the bear market, because that guy never existed, and it doesn't happen. And the mistake that a lot of people make is that they've probably made one mistake already, and they've sold off heavily towards the bottom of the bear market. And the second mistake they make is not to readily get back in, and they wait until things are nice and comfortable and the commentary's positive again. And guess what? If you do that, then you've missed probably 80% of the gains. So you've just got to judiciously start to rebuild your exposure into the stocks that are going to do well. The good news is that quality stocks, and there are still some absolutely quality businesses out there that aren't going to be impacted by a global recession to any significant degree. We've still got decarbonisation is still such an emphatic theme. It's not going to go away. Community pressure will not allow it to go away. So the supply and demand in that area is going to be good. Commodity prices should remain buoyant, and that's going to be really good for the long term for those stocks. And quality stocks are now much, much cheaper than they were. So that's the good news. Portfolio Analyst last week was actually a review session, which is what I do once a month. So very much about education. We looked at a plausible alternative scenario which was emerging. I think members found that interesting. We certainly focused a lot on technical analysis, so how to get better at analysing the money flows in the market. And we also looked at precious metals as well, and whether there was any potential joy there. That's it for this week. More information on my website. It's my email address, and I'll be back with you next Sunday. Cheers.